Pay attention to George Robertson. He knows about the bond market and the Fed. In fact, I was just going through your stream, George. Welcome back to Face. Happy New Year.
Yeah, happy New Year to you guys. Thank you. Thank you for having
Oh,
me.
wow. Looks like a little purple haze happening on the screen.
I can't help it.
So,
I just don't have
what
the
do you?
bucks you do, Dale, to have a studio. So
All
I
right,
got to
it's
put up with the
okay.
Zoom background, and I just rolled out of
I
bed, sweatshirt.
all right. What's your sweatshirt say?
That's the. I'm proud to say. I'm glad you asked. That's the USS Bruins. My one of my kids served as an officer on that.
Oh, okay. Congratulations. Yeah, good to be a proud dad.
All
And
all hers, not me.
yeah, okay. So, George, I went to your stream, and a lot of people are talking about what the Fed's going to do next month, and they're talking about the Taylor rule, and you actually have a little derivation of that. Said the Taylor rule has become the Yellen rule.
That's
So,
right.
can you
That's
explain to our audience?
Yeah, sure.
Uh,
When the Fed and the administration had a problem with the lackluster low growth that we experienced ever since say 2013 or so, they had to monkey with the Taylor rule. Otherwise, the Taylor rule was always showing a results for Fed funds that were impossible for the Fed to apply. So they replaced the CBO trend growth potential with various rules. There's about three or four rules, which is like double the employment growth, or this or that. Uh, and Yellen actually tried to claim some of this. I can't remember exactly what her formula was, but she called it the Yellen rule. The Atlanta Fed has a very popular utility. It's worthwhile looking at. It's the Atlanta Fed Taylor rule utility. And as you fill in the numbers to figure out where you think the Taylor rule is, it gives you like 10 choices to figure out the growth, and about 5 choices to figure out what the inflation to use, and then whatever coefficient you want to apply. And it seems people are going in,
and is this
and
how the Fed really derives their decisions by
I think
having
actually
10?
right now they gave up on the Taylor rule a long time ago. This is
Okay.
all marketing and propaganda.
All right.
And it's interesting to see how some, I would call it, although it's a very respected hedge fund slash PE guy, comes up with his own bias of what he thinks the Taylor rule should be to confirm that the Fed is going to ease. That they use this uncritically, without the study and the great amount of criticism and presentation of the original Taylor rule. It's just slapdash. So that's making the rounds today, and it's just another marker of how flaky and how out to lunch the community has gotten in terms of understanding the Fed, and also the Fed's relationship to inflation and the economy.
What do you think they're going to do next month, George?
I'm gonna actually be a pain in the ass, Dale, and I say it doesn't matter.
Okay,
It,
that's
it will it'll
doesn't
matter in
matter.
terms of sentiment and people getting excited and running around back and forth on the sides of the boat, but it doesn't matter in terms of the U.S. economy, nor inflation, nor issuance of debt, nor anything that really does matter.
It matters to the dollar, and I think the dollar matters.
Only in terms of sentiment. And now
Okay,
that's sort of an aloof way for me to be able to
okay,
jam market reality into my belief. But
okay.
I think my belief is based on pretty pragmatic, normal cause, and I'll have to suffer the month or two as people get overexcited about the Fed, and then they're going to come back just as they have for the last 3 years to the reality of the U.S. economy.
Okay, so this might be setting up more rally and risk as people remain euphoric if they do it. But then reality starts to set in a few months down the road. Are you kind of looking at this spring as an inflection point because perhaps inflation might start to heat up again?
Well, it seems my success in markets is I have to dive for cover and say I work in an 18-month cycle. Sooner or later,
Okay,
one of the
yeah.
market moves will justify everything I said. If you remember the last time I was with you, pretty well everything I said then came about. Now, of course, when I said it, it sure hell didn't look like it was going to happen. But I'm going to say that, damn it, I had the foresight and the knowledge, and it did come about just as I said, pretty well.
Okay.
All I can offer you, and I really get a kick out of listening to your peer group, is that I could just give you a really fundamentalist sort of like pounded into me over 20, 30 years of working on Wall Street in fixed income idea of what is actually going on. And it is clearly being dwarfed or swept away for long periods of time by sentiment and the way the market's trading, and also the big Fed propaganda machine. That
Was this
isn't
a
the
sentiment rally here in the bond
I,
market?
I think that until equity gets to, here we go, I'm making my 18-month call.
Okay.
Until equity gets to like 30, 40% up from where it is now, and it won't be a blow off, it won't be a capitulation, although it probably is more profitable to trade it with that mentality. It will be because that the sentiment, the the Fed propaganda machine is giving up on trying to jam risky assets into their presentation of what's going on with the U.S. economy and, of course, the Fed. Right now, since after the top of 2021, the Fed has been just jamming everything they can into saying, like, you're going to get it and get it good. I'm going to raise rates. It's going to be
Yeah.
bad. Unemployment's going to go to the moon, blah, 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 blah. And there hasn't been one data point that has shown either the presence of that policy or affirming that the policy is working. It actually, every data point we've had since Jan 22 has been to show that there is no Fed. So that's why I cheekily say I don't really care what the Fed does, but I would really care if you were to hand me X amount and say, go make money in like Canada or the euro. I would quickly probably shed everything I just said and just say I want to stay alive, and so I will trade the technicals rather than the fundamentals. I cheerfully admit that the fundamentals are probably if you're investing your 401k for the long run, if your whole way of life is going to survive, if like the endowment of such and such of multi-billion dollars, you should listen to the fundamentals. In the end, that is what will make or break you.
Okay.
But in the interim, I don't know if that's going to be very effective in terms of like the next week or two.
Okay. So I look at this and I wanted to have kind of a visual understanding of what some of the bulls are talking about, George. And,
Sure.
this is back to the, 21 high, and then we stalled up there a little bit. If you consider this a breakout and this whole range here, it measures 6,100 S&Ps. Is that
Mhm.
within what you're talking about? Like we have a orderly trend move to the upside towards 6,000?
I think what you're showing here for 2022 is the full force and fury of the Fed to try to contain the stock market.
Yeah, this and
What happened?
yeah, and that was it. And they were still
Yeah,
raising rates, and the market started to smell that it wasn't working.
it was bullshit. If you look
Yeah,
back at
okay.
21, if you
Get
look
right
back
to
at
the point, George.
yeah, if you look at 2021, I don't think the Fed's going to hire me anytime soon anyway, so I can say this stuff. But if you look at 2021 after COVID, that market pattern is probably, from my point of view, more in sync with the economic reality that was presented to the market, not by the Fed or by trends or anything, but was presented by just like we are going to jam like making a goose liver ready for foie gras,
Yeah,
$3.5 trillion in perhaps the shortest span of time of one of the largest numbers
in
since World
human
War II.
history. Yeah,
And that's what happened. And then
yeah,
thereafter is the attempt of the Fed
to
and
drain
other
it.
interested parties like Jamie Dimon in January of 2022 saying that, wow, if this really reflects what's happening with the Congress and the fiscal policy, then boy, it's going to get weird quick. And it could get into such a force that JP Morgan's
Oh
basis
yeah,
is threatened and so
he
on.
had war rooms set up.
Right. So therefore, I think what you're seeing there in terms of this choppy, finally getting back up to the highs of 2021 is what the power and the ability of the Fed is to try to cap that. They do not want to get into a Greenspan exuberance type of situation.
Then
They
why did he
already
turn? Then why did he turn into Arthur Burns at the last meeting,
um,
taking victory laps?
I think he's in trouble. I don't think Powell's a dummy. I think he's a bureaucrat par excellence. He got turfed out of Carlisle because he wasn't allowed to get to the main table. But he's a good fella. He seems very, very bright. He's a great administrator, great bureaucrat, and you would think he would make a good Fed chair. But he's been all loose and cowardly almost in terms of how Trump backed him down in 2018.
Yeah.
And he's been very responsive to the political
Who
edicts.
backed him down this time, George? I mean, a lot of
Biden,
people make it political and say, they're Democrats. He's starting to ease to help Biden get reelected. Do you buy any of that?
100%. I
You
think
do? All right.
I think you said Burns, which is appropriate.
Yeah.
Burns' relationship to Nixon. I don't
Yeah.
think it has anything to do with party or a conservative or liberal stance. It's got to do with this guy wants to get reappointed probably for another 6-year term in a couple of years. And he also wants a legacy. He does not want to be a Burns. He does not want you to say he
Oh,
sounds like Burns or
he's
Miller.
got a legacy already.
Yeah, it's as a failure from my point of
Right.
view.
Right.
And
Like most, eventually, even the Maestro years later was called a failure.
that's it.
Huh?
Volker's free game now to throw bricks at.
Yeah, he's the
Um,
last one left. He's the
yeah,
only godlike figure from the Fed.
exactly. I think the problem is that the Fed has bitten the apple. It has gotten into a persona, a reputation of like way more important, way more powerful, and way more effective than it ever was meant to by law or by reality. And they're now eating it. A lot of this goes back to 2012, 13, where when they hit rates at zero, they couldn't follow the rates down to negative as per Taylor rule or other understandings of monetary economics. So they had to come up with all sorts of bullshit about like, well, zero is pretty good because we're going to do QE and QT and all sorts of propaganda, basically what it is. And then once rates actually got off zero, because the economy did start to grow, a lot of it from the shock of Trump's corporate tax cuts and also with, of course, COVID, they had already adopted a policy to paint things with all this crap with ZIRP and zero lower bounds, which is called neo-Wicksell Woodford. Now people get, what the hell? Why would I, if I'm just trying to survive in Forex for the next week, ever want to know anything about it? But I think it's important to really understanding and come to your own opinion about what neo-Wicksell means. Woodford, this is the 2012 paper that Woodford presented at Jackson Hole. And the vast change in the whole Fed's way of operating, ways and means, and the reliance on nothing but propaganda afterwards.
You need to write a book, George, or have
Anyway,
a course,
what I
to
just said,
teach.
Dale, ain't making me much money. So anyway, I'm having
All
fun,
right,
right? Okay.
all right, okay.
Um,
It's not always
and
about money.
it's not always about money. I thought maybe it should be. And the risk manager in my house,
Is your
my
wife?
partner is very askance at me babbling away about all this stuff. She's, where's the money? Okay, what can I say?
Show me the money.
Show me the
Yeah.
money. But I have some schemes and things that I've done over the last 30, 40 years that at least allow me to operate. And
Do
this is not my house's background, by the way. This
yeah,
is just something I choose.
yeah.
Anyway, what I'm getting at is that everyone should be aware that as long as the propaganda and the bullshit that the Fed is putting out, in which almost everyone's adopted wholesale, like this is reality, is aware that it ain't, that it is almost getting to a falsehood. Every time Powell goes in front of Congress, he's perjuring himself now. I don't even think he believes in this stuff anymore. But carry on, because there's certainly more of the characters who think I'm out to lunch and just a mad old guy versus anything that can be used week to week. So we're going to trade the propaganda and the setting of the Fed. But you should be always aware that there's probably a 20% change in a lot of stuff once this is disclosed. Once everyone realizes that the Fed's an empty suit, we're going to have massive cuss moves in the market, both up and down. And it will happen well, we've seen these things in the past when this type of correction.
This year, George, this year,
pardon?
Could it be
I
this
don't
year?
think so. I don't think this year, because Trump's got to get elected. And a lot of congressmen got to ride on Trump, or at least hold the line so that they can go to as opposition. There's a lot of money that's been taken from crypto lobbies and this and that. So Congress is, who am I to say they're corrupt? But anyway,
who's going to be the next Fed chair? I
think it's Brainerd. I think Brainerd's being.
If it's Brainerd, it means it's not a Trump victory,
right? But it could be Brainerd in terms of maybe Biden does something sooner for the election, but that's okay. Unlikely. This is what I'm saying, is that it's unlikely this year. Okay. And there's a thought that it might not take place next year, or at least half of it. This is a great romantic setting for, Trump gains victory, and then he sits on one of the biggest debacles in U.S. financial history. There's a lot of people who think that's very sweet, but the setting is there. There is no Fed that's effective. The fiscal is out of control, and it's got nothing to do with I hate deficits, they're bad. How are we going to pay for this?
It has nothing to do with political parties. It just comes down to when the plug is pulled.
Exactly.
When the con is exposed in confidence.
Say it ain't so, Joe. It's just say it ain't so. And I did rig the World Series. There is going to be this realization. Now, there's a chance that the Fed might ease back to reality through subterfuge and gradualism, but I don't think so. I think they've gone too far off the rails. Okay, so anyway, there's I think I've said some dramatic stuff, which might be of interest, but I can't be held to anything that happens.
How do you invest in an environment like that? You just stay in T-bills?
Yeah, no, as far as investing, yes. Okay, let's say you don't have the option to be short. If I did have the option to be short, I'd be short the U.S. Treasury 10-year, because I think 6% is the results of everything I say. I also think that I don't have much view on international. I have a hard enough time trying to be, somewhat cogent in just the U.S. stuff. Okay. I took a play in Boeing, which is just gutting me. It's
I see.
Who the hell? I didn't know that the sides of the plane were going to fall apart. And I thought they'd stop crashing into the sea. But anyway, that's my excuse. But I'm getting screwed.
This is a big call, because it's very contrarian. Most people think that we got to the terminal rate. And
I think to think
you're saying something else.
Well, to think that the 10-year will trade under 5% when NGDP is likely going to be over 5% for the next couple of years, and inflation, I think, is going to be pretty sticky around 3.5%. That 3.5% will define Fed funds, but it's not going to define the 10-year. And I think the 10-year is going to be based upon the expectations of U.S. GDP growth, which I don't think many people are arguing with the fact that it's probably going to carry on as it is, maybe a little stronger, maybe a little weaker. And that requires a 6% U.S. Treasury rate at some point. It also requires the Fed to stop
supply crowding out those kind of things.
No, this is where I get even more ornery. U.S. Treasuries are risk-free rate, if I can use that label rather than U.S. Treasuries, because I think they're being very much pressed and modified by where the Fed buys U.S. Treasuries. But if we look at the risk-free rate, that is never dependent upon supply or demand of funding. It's based upon NGDP. Full stop, period. It's the way it has always been, and it's the way it's always going to be. Now, at any one point in time, there can be a lot of buying or selling if by the Fed, which can pressure what's called sector segmentation into a mutation of where the curve should be and where the rates are. But the risk-free curve is always with us. And what I've shifted to was that after, since the products were created, there's been a divergence of U.S. mortgage rates, 30-year conventionals, which is usually pegged to the 10-year, altered for, convexity. It's a mortgage versus a note. And if you alternate that, you come to an equivalency with U.S. risk-free and the U.S. Treasury 10-year, which ended last in 2021, 22, in a dramatic way. So this relationship has been upheld for decades and decades and decades. And just since COVID QE, it all went to hell. So I'm just gonna, because I could do it and because I don't have my job dependent on it, I can just dismiss where the U.S. Treasury 10-year is trading and look at only U.S. mortgage rates as an indication of where the risk-free rate is. And if you think about it, U.S. mortgage rates being government-backed in the end, they go into mortgage-backed securities and they're quasi, they are risk-free, basically. If you adjust for that transformation to mortgage-backed securities, and then also get to the equality of a fixed income semi-annual bond structure, the mortgage rate has to respond to the economy. People either buy houses or they don't buy houses. They buy houses because they got more money. They don't buy houses because things suck. So the U.S. mortgage rate is always a fair rate, an efficient rate, a rate that actually discloses where the U.S. status is in terms of economic growth or decline. And so it is the reals, I don't want to say real GDP that's wrong, but it is the risk-free rate of the United States right now. And that spread between that has grown it used to be like 130 basis points, 1.3% into 21. That thing is just blown out to 3%, which is something it hasn't done ever since mortgage-backed securities were created in the 80s. So something's going on. That's my explanation. But I think everyone should give pause to that before they come up with an idea that U.S. Treasury 10-year has something to do with something with the U.S. GDP. It doesn't. And if it does, it should be at least 5.5 now. On the basis of what I just explained, it actually touched 6%. So adjusted in 20, in quarter 3 last year, before all the quarterly refunding announcement hoopla. And there we are.
Okay. So here's George's X handle. And looks like you have a Substack little column here, right?
Yeah, I have two causes for that. The first thing is that I got to please the risk manager at home and try to figure out some way to make some money. And also, I have a guy who thinks I'm adequate for his partnership. He's 5 times brighter than me, and a Duke Folk scholarship type guy, young fella named Riddick Goyle, which is also worth a follow too, at RP Goyle _. So I got to figure out how to make some money on this stuff rather than just have fun and play and talk stuff.
Okay, well, I want to wish you good luck on that and everything else in 2024, George.
Okay, and
you really, you really are an academic in the bond market. Really, I haven't heard this kind of stuff from a lot of people that say they're fixed income people before. So, thanks for edifying our community today.
Well, Dale, I'm going to assume that's a compliment, not
It is.
like a head shake. Anyway,
My
just like you did
biggest,
last time, I'm all set to come back on at whatever time period you want to either eat crow or to revel in my brilliance.
all right, well, this spring we'll see what's on the menu.
Okay, sir. Thanks for the
All right,
time. It's a big
all right,
compliment.
George.
All
All
right.
right,
Bye-bye.
George Robertson, everybody. Hope you enjoyed him. Check him out there at his website and see what his writings do for your insight into the Fed. And that's a wrap for me. In 17 minutes, you have the team on the morning edge. Don't just count your coupons, count your blessings.
Hey traders, this is Blake Morrow with Forex Analytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.